The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal.
Fed Chair Jay Powell there rallying markets with a more hawkish view on the rate cut outlook. We're just half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. Our top stories this morning. Powell's comments signaling further delays in rate cuts, setting Treasury yields to fresh 2024 highs. You have Asia's stock benchmark now on track to erase all of the gains for the year. The renminbi still in focus after the PBOC's recent attempt to loosen its grip, and as the dollar heads for its biggest rally in over a year. And Xi Jinping pushes back against pressure to rein in industry, telling German Chancellor Olaf Scholz a surge in tech exports has helped the world tackle inflation. All right, we're taking a look at the price action here this morning, and it's not looking as bad as yesterday, which is something that is a good news for those long these markets. And just given what they heard from Jay Powell, you got to wonder, did he do a 180 when it comes to that December pivot? You know, when he talked about, look, they need to get a little bit more confidence and inflation at 2% and before really keeping rates lower, cutting rates here. So certainly after 3 CPI prints later, it seems like he's dialing back. That's why you're seeing a bit of that move into the dollar once again. That's why you're seeing Treasury yields, that U.S. 2-year yield briefly touched 5% for the first time in 5 months before finding some support there as well. The Bloomberg Dollar Index we talked about, right? We're on track for the best run in 13 or 14 months or so. We're up from 5 sessions already. Seeing a bit of stabilization here, but that's really roiling the EM trade, whether it's stocks, whether it's currencies, where basically now EM assets have sunk to that 2024 low. We'll get to that in a minute. Obviously, we're watching, of course, how Asia does. We talked about how we've erased the 2024 gains for stocks already, and we're watching very closely that PBOC fix in just a few minutes' time. In terms of what we've heard in terms of the damage report so far, so it looks like things are looking a little bit better in the Asia EM FX side of things. We talked about that rare statement, verbal intervention from Korean officials here after the Yuan did hit that 1400 level yesterday. Taiwan dollars at a 2016 low. The ringgit is also near a 26-year low, and we're watching very closely what goes on with the peso as well at 57. Anything higher than that, we're past those past intervention levels as well. Keep in mind, it's not just that, right? We're watching rupiah near that 16,000 level. India rupee also slid to a record low yesterday. So it seems like nobody is immune at this point to this dollar strength of late. You take a look at how the China setup is looking like here today. So, you know, we did see at least the onshore market, relatively speaking, less bad, but still towards the end of the session, things did look a little bit further south. So we're still pointing slightly negative here this morning. Chinese 10-year yields at 226, and we're talking, 730. Is that the next test for dollar China? That PBOC fix, if we see another looser, weaker fix here today, what is that going to be signaling to the market as well? So that's really part of your agenda here this morning, that PBOC fix. Offshore yuan HIBOR also looking a bit elevated here as well. So the cost to borrow renminbi is also getting a bit more expensive. And we're watching very closely that spread between the offshore and onshore rate as well. Property developers now there was a little bit of a rebound in some of these big names on news of maybe some sort of national sort of platform. We'll talk a little bit more about that later. Small caps are just still getting really hit hard, and I did hear from some regulators trying to ease those concerns about, market reforms and talking about delisting fears out there right now. And we're still in the window for some FDI data as well. I want to bring in now my guest, anchor buddy for the hour, Stephen Ingles, our chief North Asia correspondent. What's top of mind for you, Steve?
Yeah, I think it's the Yuan, obviously, and we're going to talk to Stephen Chu in just a minute about that. Again, it's the PBOC's constant battle to try and find an acceptable pace of weakening at a time when all these central banks and all these currencies you just ran through are just trying to hold back the dollar tide with a vegetable strainer, right? It's just not really working right now. And so you're seeing most analysts expecting 7.3, as you rightfully said, to the dollar on onshore, even offshore by the end of the quarter. We hadn't even mentioned about what's happened with the yen, obviously, at 154.70. It's going to test 155 potentially.
And there was a brief spike in the yen, just like seconds.
Brief. That's what we've seen, brief.
But it just goes to show how sensitive this market is to any sort of intervention.
Sure. So is the finance ministry going to jump in? There was some speculation, but then that petered out, but it still could. 155 might be the line in the sand. And again, what is the line in the sand for the PBOC on the Yuan? As again, they don't want to see too much weakening too fast. That could spark market panic as well as some outflows, and they don't want those outflows.
Yep, and it all really came down to more comments from Jay Powell as well. It seems like he's signaling a delay when it comes to those rate cuts. Take a listen.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's bring in our Bloomberg Intelligence Chief Asia FX or rate strategist, Stephen Chu. Now, I'm sure he's been a busy man. Tell us about the fixing patterns that we're hearing from the central bank.
I mean, as you say, it's a strong dollar story. So China have been keeping dollar yuan fixed very stable, but now they're starting to loosen it. For example, yesterday. I think it's obvious because the yuan basket is so strong. If you look at the fix, the yuan basket is over 100 already. If you look at CNH, the basket is over 99. So that's why they will have to let it go a little bit time by time, as Stephen has said earlier. It really depends on how long this dollar strength can last. If it keeps strong, then basically the PBOC has no choice. They just have to let the fixing to grind higher gradually.
Gradually is the key, right, Stephen? You have green tie, you have green glasses, green back, okay? But again, how fast is too fast of weakening?
Yeah, thank you for noticing this green back theme for today. Yeah, so Yvonne pointed out 7.3. I totally agree with that. Because if you look at like the fix at 7.1, so now that gives you a sort of like upper band at 7.25 below that. So probably now that's the red line for PBOC. But 7.3 eventually will be hit once the dollar strengthens further. Yeah.
I mean, it's not just the renminbi, right? We talk about all these superlatives for Asia FX. How do you think, are we likely to see more sort of central banks have to step in and do something now?
Absolutely. We have actually put on yesterday saying that this quarter is actually the key theme is watch out the Asian central banks. They're going to have to intervene verbally, like even actively. Yesterday, as mentioned, Bank of Korea made this very rare comment, and then Bank Indonesia intervened, which is not often actually. And then like this morning, like we heard from Japan, heard from Korea talking about the currencies. And if you look at the levels, it's also very interesting. The ringgit 4.8 is the level that they care about. And then also like Taiwan dollar 32.50 is what CBC cared about last year. So now they will just have to be watching the FX market very carefully, and we will have to watch out for news that central banks are in the market.
We're watching, obviously, waiting for the fixing in the yuan. What other further tools does the PBOC have, though?
I think, as you mentioned, like the offshore liquidity, CNH liquidity has started to sort of spike up a little bit. So again, that's one of the two that's most effective, despite like probably just for a short period of time, that could squeeze CNH shorts and sort of merge the CNY and CNH. That can work a little bit for a while. But eventually, again, if the greenback stays strong, then it's very hard for them to hold the yuan back.
Okay, what are you watching out for the most today? Beyond just the renminbi, what's on your radar?
It's basically news about central banks in the market across Asia.
Where can we see more of that downside, though, in Asia FX now?
I mean, like, the direction is clear. It's just that, like, from here now, the drop is going to be more gradual.
Okay.
Yeah.
All right, Stephen, thank you. Stephen Chu there, our Bloomberg Intelligence Chief Asia FX and Rate Strategist, joining us now. Just ahead, we're going to talk to Bank of America Securities, thinking a sustained macro recovery in China could drive more market upside. Winnie Wu, China Equity Strategist, joining us next. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Of course, we did see that CSI 300. We've basically been down for the past 8 out of 9 sessions here. Futures are pointing slightly down this morning. This is the China Show. Good morning. All right, China futures are heading south here this morning. We'll see if we continue to see this fallout when it comes to risk assets. It looks like things have stabilized just a little bit compared to yesterday, though, but we're still watching very closely that dollar-China trade, 726 as we speak. Let's bring in Winnie Wu now, China equity strategist at BofA Securities. She's here in our Hong Kong studios. Obviously, we've seen the macro data with blowout numbers in the first quarter. Seems to look a little bit better. And people keep wondering, is this a sustained rebound in the equity market or another false dawn? What's your take?
Yeah, I think yesterday the macro number surprised on the upside, but market traded down. It's partly because one, overnight U.S. data was too strong, so the expectation for Fed rate cut was pushed back. Yeah. But on the other side, with the very strong China GDP, it basically means if Fed is not cutting and China fundamentally is doing fine, then the need for China doing a big policy easing is probably much less now. So the lower policy expectations on policy easing is probably one of the key reasons. The other reason is the first quarter strong number has some base effect, especially for January, February, right? First 2 months last year, it was right after reopening. So whether it's the import-export trade, industrial production, or even on some of the online retail sales number was relatively weak. So we got very high growth in the first 2 months of this year. But in the coming months, in May, in June, when we get the April data for trade, for industrial profit, and even online retail sales, we are likely to see the sequential slowdown.
Right, Winnie, that was exactly what I was going to ask, because we really saw that pickup in growth of 5.3% in the first quarter in the first 2 months of the year. In March numbers, the retail sales were down. Yeah. Industrial production didn't meet expectations. So what does that tell you about the sustainability?
Yeah, I mean, if you're talking about sustainability of the first 2 months, definitely not, right? As I mentioned, there was a lot of base effect distortion that drive, for example, industrial profit. It was growing 10% year on year for first 2 months of the year. That's because the base was negative 23 for first 2 months last year. Similarly, trade number, January, February last year was the lowest and then peaked out in March, April. So export number in March, April this year is likely to continue to weaken. So, the first 2 months of strong number is very unlikely to last. But on the other side, we do see signs of resilience, whether it's consumer confidence, whether it's domestic consumption, or even on some of the, export production side, Chinese products are competitive, right? So I think, no need to be overly bearish on China as well.
So what does it mean for the next 3 to 6 months then? Are you thinking this trend can continue, maybe more upside?
I suppose in the very near term, next few weeks, market might see some signs of weakness, right? Okay. After the good rebound from end of January, early February, markets were up double digit already, but with the good news in the price already and the sequential weakness of the data in the coming months, we are likely to see potentially weakness of the overall index level.
How do you see the fallout coming? We've already seen the last couple of days from the State Council announcement on Friday about the increased rules on potential delistings and getting rid of zombie companies and the like. I mean, that really took the wind out of the sails of the CSI 2000 of small caps. Is this a concern, serious concern, or is this simply due diligence by the CSRC? They're trying to allay the fears of investors.
Yeah, I mean, I think the intention is definitely trying to protect the investors, trying to enhance the discipline and, this compliance auditing on the Chinese companies, right? The quality of reporting, the concerns for shareholder return in terms of requirement on enhancing payout. All these, I think, are to protect the investors. It's for the good thing. But on the other side, it does mean that some of the long tail end of the, micro cap companies could be under more scrutiny and face potentially delisting risk.
All right, just want to hold that thought. We have that renminbi fix just crossing our Bloomberg here right now, and it looks like it's the second day where we've seen that fix at 710.25 this morning. So this is the second time that we've seen, in fact, where we've seen 2 straight days where that fix has been above that 710 level. First time since early March we've seen that. So once again, another day of loosening the grip on the currency in some ways. Winnie, can the equity market still do well if there's so much volatility in the renminbi?
Generally speaking, you see some correlation between the currency and the stock market, right? If currency is facing a big depreciation risk, generally it's not good for risky asset in China at least. Yeah. So when I was marketing in US a month ago, some New York hedge fund was making the bet on RMB big depreciation, especially in light of the potential tariffs from the US. People refer to, look back in 2018 when Trump put on the 25% tariff, RMB depreciated by more than 10%. However, our view is that at least in this year, I think RMB defending the stability of the currency remains a high priority for the central bank and the government.
So what would be an optimal pace of depreciation if you're battling that never-ending tide of dollar strength, obviously? They don't want to repeat 2015 volatility.
Yeah, I mean, there's no ideal path, right? If you do a gradual depreciation, basically you're wasting your reserve every day to defend every point of the currency, right? Which is bad. But on the other side, if you do a one-off depreciation, let's say RMB depreciate from 7.2 to 7.6, but then market might panic and say, no, 7.6 is not the right level. Let's target 8.2. By the time it's 8.2, market may be looking at 9. So during this process, the currency, the confidence may face a situation of free fall and losing control. So there's really no good way of depreciation for China.
All right, Winnie, we'll have more from Winnie Wu there, China equity strategist at BofA Securities. She's staying with us. You take a look at, I just want to recap that fix, right? 710 for a second straight day. You're not seeing a huge movement when it comes to dollar China here. We're still hovering that 726 level as well. We're also watching one stock in the pre-market, which is AIA. It's moving quite a bit here. Morgan Stanley had an interesting note talking about earnings per share rebound, basically saying improving fundamentals is going to help drive that share rebound. So indicated higher here this morning, at least about 4% according to what we're calculating here this morning. So the Hang Seng, there you go. Oof, we're down some 2%. Again, I have to check that, if that's the pre-market. Sorry, this is the last close, keep in mind, from yesterday. So we haven't seen that pre-market just yet. This is Bloomberg. All right, this is what we're looking at in the pre-market there. This is the right one. We're slightly down this morning, so possibly could be extending some of the declines, the steep declines that we saw yesterday. But we're certainly watching that fix, holding steady once again at 710. But again, another weaker fix from the PBOC today. Here are some of the big corporate stories we're following for you. HSBC is said to have started a new round of job cuts at its Asia Investment Bank. Sources say the lender laid off around a dozen bankers on Tuesday. It comes as deal making across Asia has slowed, especially in Hong Kong and China. Other banks, including UBS and Goldman Sachs, have made rounds of job cuts in Asia over the past 18 months. LVMH has reported slower sales growth as wealthy consumers reined in spending. Organic revenue at the luxury group's fashion and leather goods unit rose 2% in the first quarter. That's the slowest pace of growth for the period since the pandemic began in 2020. Sales in Asia outside Japan fell 6%, although Chinese demand was higher. Meanwhile, Chanel CEO says that China remains an important market for the luxury sector. Lena Nair also told us exclusively how recent price rises are a product of inflation.
We raise our prices according to the inflation that we see, so they're really linked to the cost price. We've also made a commitment to price harmonization across the world, which means our clients should not experience excessive price differentials, no matter where they buy. So we want to stay fair to all our clients everywhere. So it's really because of that we've increased our prices, our cost prices, and our commitment to be fair to all our clients and ensure price harmonization across the world.
And how do you see the China market right now compared to the U.S. market? Because it's not that volatile, actually. You kind of have like a base that stays for quite some time.
China is a very important and dynamic market for luxury. China is a very essential market for the luxury ecosystem because of the fast adoption of luxury, because of the retail spaces being so beautiful and so luxurious, because of the appreciation of refinement and sophistication. So it's a very important and essential market for us. We are a long-term company, so we continue to believe in China, continue to invest in China. We have 19 fashion boutiques, 5 watches and fine jewelry boutiques, and 270 fragrance and beauty boutiques, and we're going to invest more, open more doors. I came back recently from China, and I was really happy to see the energy and vibrancy in the market. So we continue to run our business for the long term and continue to invest in China for the long term.
That was a Chanel CEO, Lena Nair, there with Bloomberg's Francine Lacroix. You take a look at how the pre-market is looking here this morning. We're slightly seeing some declines early on here. Of course, we're watching very closely what goes on with Asia FX here today. Looks like we're stabilizing after the pretty big bloodbath yesterday when it comes to Asia FX. The dollar, though, is still slightly flat or holding on to at least 5 days of gains here. And we're looking very closely at what goes on. So H shares are pretty much flat here. HS Tech, slight bid, if any. In terms of analyst actions to tell you about, we're focusing on the banks, we're focusing on casinos here today. Galaxy Entertainment cut to equal weight at Morgan Stanley. JP Morgan also downgrading the casino operator and saying disappointing recovery and modest drops in EBITDA as well. ICBC A shares rated a new ad. Huaqiang Bank of China A shares also rated the same at the same brokerage as well. And we're watching in terms of stocks to watch. So yesterday, there's a big movement on some of these property developers. There seem to have been some reports from Caixin talking about establishing a national real estate platform company to acquire unfinished properties. So that certainly helped the likes of SIFI Holdings, which really led that charge. It rose double digits before coming back. But we're seeing a second day of this here. Sino Ocean also up some 2%. Times China, though, that was with the wind-up petition. We saw double-digit losses yesterday. We're slightly seeing some declines here today. And Fitch also revising their outlooks for Chinese state banks to negative as well. So we'll see if there's any sort of reaction there. Nothing early on, but we talked about AIA earlier as well with that Morgan Stanley recall. Galaxy Entertainment, though, as we talked about some of these casino operators, down about 1.5%. BYD also coming out with some new models here in the luxury space as well. You take a look at how GMM and your global macro movers are looking like here today. So things are looking a little bit better, maybe a little bit more calm as we kind of digest what we heard from Jay Powell yesterday. You know, it's interesting, right? Back in December, he said, look, the Fed is considering cuts and we might be able to cut before inflation hits 2%. It seems like he's backtracked quite a bit yesterday in his comments, talking about, you know, rates might stay restrictive unless they get more confidence that inflation is heading in that 2% territory. Look at the TAIEX, though. We're recovering about 1% here. When it comes to some of these equity benchmarks, Japan still slightly lower, but we're still seeing bonds still in the red this morning. The open is next. This is Bloomberg. Back, you're watching the China show. We're kind of on the open of markets, and it looks like, you know, we're still seeing MXAP there basically erasing 2024 gains for the year. So we'll see if this actually continues here this morning. Of course, as Powell signals that maybe those rate cuts could be delayed after, of course, the 3 CPI prints that we've seen here. So certainly this is a Fed that's still very much data dependent. You talk about whether the pricing of Fed cuts is not now from 2 or should we start pricing to 1 now? That's our question of day to our viewers. Take a look at how the Hang Seng is looking here. We're seeing some slight declines across the board. The currency is pretty much has been stable in the last maybe few hours or so, just given despite that PBOC fix, which once again punched above that 710 handle. The first time we've seen 2 back-to-back PBOC fixings of 710 since early March. So signs maybe of them still loosening the grip a little bit when it comes to the currency. You take a look at how HS Tech is doing. We're slightly bid up here, so that's helping the Hang Seng stay slightly to above water, about 0.25%. CSI 300, certainly that's been the standout, I guess, if you look at this divergence. But you take a look at what the small caps have been doing. As Steve mentioned earlier, that state council statement talking about more capital market reforms and these delisting concerns have really sent the CSI 2000 down some 11% in the last 2 sessions. So we're seeing a little bit of coming off that now. We're seeing a slight bit up here when it comes to the CSI 1000 and 2000 gauges here. And we're watching very closely what goes on with commodities as well. So Brent's pretty much in this sort of calm period as we wait for any more developments out of the Middle East. But you're seeing a slight bit across Shanghai crude as well as in iron ore here today. So that's what we're seeing there in terms of movers. We talked about the banks a little bit. Now, Fitch just came through and changed their outlook when it comes to these lenders as well. So these are more the state-backed ones, the likes of ICBC, Bank of China, with that negative outlook here. So you're seeing just a little bit downside here in some of the banks. Galaxy Entertainment, that's the big drop here today. We're down some 3%. JP Morgan downgrading that stock to neutral. They talked about disappointing recovery, modest drops when it comes to EBITDA. They're thinking more MGM China, Wynn Macau as two clear winners within that casino operator space there. BYD, no movement there, really, unveiling some new models as well. Developers, though, we'll see if that any sort of traction from yesterday after some news of them creating this national platform. Well, it looks like we're continuing these gains once again. SIFI Holdings, which was the clear outperformer among the pack yesterday, we're seeing gains of close to 2%. Sunac China, Chinawanka as well are all up here this morning. Times China, that's another story here with that winding up petition yesterday. So continuing those declines for a second day. But the BI China Developers Index, at least we're seeing some modest gains this morning. Let's get to that here real quick. The Caixin, their local media reporting yesterday that officials were considering a national real estate platform company to acquire unfinished properties. And Steve, certainly that was what really sent these property stocks lifting. And you got to wonder how these projects and these white lists, how things are faring so far.
Yeah, I think the market's searching for any good news in the property sector right now. And again, this white list or this national platform to purchase unfinished properties, unfinished units, or is it the entire developments? The big question is who gets that handout? Who gets that aid? Is it a larger company, the former bellwether of the industry, like a Country Garden, which is now coming out and essentially telegraphing that they might be late again on onshore bond payments. This after getting several extensions on bond payments last year. Look, they have a massive cash crunch. They would love to be on that white list. They had their contracted sales down 83%, I believe, last month, 85% down in January. So again, who's going to be on that who's going to get not bailed out? Nobody's getting bailed out, but they're at least getting assisted by this national platform company, if it is true what Caixin is reporting.
Yeah, I want to bring in Winnie Wu. She's back here with us, China equity strategist of BofA Securities. Is this still the top risk among investors that you talk to, the property market?
Yeah, I think so. For investors on China, I think the top three concerns, number one is the property market, number two is the deflationary concern, and number three is the concern on lack of animal spirit in private sectors.
So deflation.
Yes.
Obviously is an issue with the consumer. Why go out and buy big ticket items if the prices keep coming down? What's going to replenish investor or consumer confidence?
Yeah, I mean, deflation is bad for consumer and it's also bad for corporate earnings, right? If price keep going down and with, this competition in China, it's bad for corporate earnings as well. For the consumer confidence side, interestingly, despite property price and property transaction volume continue to decline, if you look at the consumer confidence index, it's been edging up from the lows in middle of last year. So far, consumer confidence at least stabilized for the past 6-9 months or showing signs of modest improvement. Of course, when we talk about modest improvement, we're talking about pre-COVID, it was like 120, right? At the worst of the lockdown, it was like 85, and now it's like 90. Okay. So it's not back to the pre-COVID level, but at least so far we've seen stabilization, and I think that's reflected in some of the resilience in domestic tourism, movie box offices, in terms of the buying the day-to-day products.
Okay, that's interesting. When it comes to deflation, I guess, as Steve alluded to, do you think that's reflected in earnings projections overall? I mean, we had a guest yesterday that said it seems like ESP and profit growth sort of expectations are still quite high and elevated because people are not discounting the fact that deflation is persisting for some time.
Yeah, I mean, in the latest full year result, full year 23 earnings season, we're looking at 3-1 miss to beat, right? So like 3/4 of the companies missed the earning expectations, and among which over 60% missed by over 5%, so it's significant miss. So currently earning expectation remains too high. For MSCI China this year, consensus is still looking at nearly 12 to 13% year-on-year growth. As we spoke before, beginning of the year was 15. Yeah. We think it will be low single digit, currently 12 to 13, so it's not downgraded enough yet.
Given all the pressure that we've been talking about ad nauseum about the property sector, what is your outlook then as well in a fairly negative interest rate environment or lower interest rate environment than in the United States? What's the outlook for the banks?
So for China banks, in our second quarter strategy report, we downgrade them into the bottom 10 list. This is more a short-term technical call, partly because China banks outperformed in first quarter. As a sector, they were up 8% when the index were down 2%. So they already outperformed, but also because first quarter earning, which will be reported in 2 weeks' time, is likely to see a lot of pressure for even the major banks because of the rate cut, margin compression, and the first quarter volume growth was lower than the same period last year. However, on the positive side, if Fed rate cuts being pushed back, China's economy is doing fine, then the need for PBOC to cut Chinese LPR aggressively is likely to be limited, which hopefully means after first quarter this year, banks' margin will see signs of stabilization. And if government can do more to help stabilize the property market, I think banks still have a relatively stable outlook for the full year.
I was going to ask you about some of these small caps because we're seeing a bit of a rebound here today. Obviously, the CSRC came through yesterday to try to at least clarify some of these new market reforms that they pay out and downplaying that delisting risk. Are we likely to see more divergence amongst the large and small caps in China?
Yeah, I think, for companies, ultimately, it's about earnings and valuation multiple. Last year, fund flow played a big role in the share price performance. So the large caps, which tend to be more well-owned among foreign investors or just a simply institutional investor, we're seeing more flow selling pressure because of the reduced weighting on China, because of the redemption pressure, whereas the micro caps, previously nobody owned them. Yeah. And then with the involvement of more quant strategies, actually outperformed. This year, we see some of the unwinding of those trade and the mean reversion. But at the end of the day, I think, fundamentally, it's still about good company, good earnings.
Winnie, what's your model portfolio right now? And how do you latch on to the gold play, the gold rise?
Yeah. So for 2024 overall, as we said before, is the barbell strategy, right? On one side is the defensive SOEs being the core holding. On the other side is very selective bottom-up companies looking for alpha. Companies either can gain market share in going abroad or localization strategy, or companies has a strategy or unique position that can defend their margins. But for second quarter, from a sector perspective, we overweight some of the internet-related sectors, mainly because they are seeing some of the relatively stronger earnings momentum, and we overweight the defensives like coal, gold, metal mining. So those are on the overweight side. And then on the underweight side, we downgrade the banks, as we talk about. We don't really like the staples, and we're cautious on, like chemicals, construction material, insurance, gas. And this is mainly reflective of the negative earnings momentum as well.
You mentioned about just the banks as well. This was always, some people thought, the dividend play, that was something that could still remain despite the earnings picture looking pretty bad. Is that still something that on your radar, the dividends?
No, I think so. So, I would imagine, if the earnings in 2 weeks' time does miss, there might be some correction, but that might be the opportunity to buy on the dips, right? Because so far, banks pay dividend once a year, which is typically exited in, late June, early July. So you still have that window to play the trade for the short term.
Technology, you said that's in your buy sector. Is it case by case or is it broadly tech? Because certain tech companies have had different challenges, the rectifications in Alibaba and the like. What's your strategy with tech?
Yeah, absolutely. Within internet, generally we say we prefer companies with dominant market share position. So, for example, e-commerce. Many existing listed companies are facing one big competitor, so that's not such a good place to be unless you have a strategy to offset that challenge by, exporting, going abroad. Whereas on media, on online games, there's less market share competition. So, the companies in those areas are having a more secure positions. Even in like online travel agent, right? Companies in that place can benefit benefit from the domestic, strong travel, domestic, and very strong hotel booking, hotel revenue. So you're right. I think, within internet, we need to look at some of the subsectors and the individual company stories there.
Winnie, thanks so much for sticking around. Winnie Wu there, BofA Securities, China equity strategist, joining us here in our Hong Kong studios. We've got plenty more ahead. This is Bloomberg. Well, the IMF has inched up its expectations for global growth here this year. You take a look at how 2024 is panning out. So they're lifting it from 3.1 to 3.2%. They're also warning of uneven global growth, and they still see a lot of challenges and risks ahead. So the fund's latest World Economic Outlook really reports cites strength in the U.S. and some emerging markets, while warning that the outlook remains cautious amid some of the persistent inflation and geopolitical risks as well. And it's also urging China to find ways to offset headwinds from its property crisis.
With an economy that has potentially still relatively weak domestic demand, but is growing, then there will be an increased reliance on the export sector, and that is something that, in the context of very tight trade tensions, could be complicated. And so certainly there would be, in the interest of the Chinese economy to develop ways of sustaining domestic demand.
And once again, the U.S. has repeated its concerns over what it sees as industrial overcapacity in the world's second largest economy. But Chinese officials have since pushed back against Washington's claims. Let's get to our news desk editor, Jill Deesa. She's with us now. So is China likely to change its policies because of what we're hearing from the U.S.?
No, I really don't think so. I mean, at this point, look, I think China's been pretty robust in its defense of some of its policies and fighting back against these claims of industrial overcapacity. It's not just, Treasury Secretary Janet Yellen, who we saw bring this message to Beijing during her trip to China last week. It was also German Chancellor Olaf Scholz, who just this week actually confronted, China over some of these issues. And it was President Xi Jinping in that meeting with Scholz who said actually a lot of China's exports, particularly around green tech, so solar panels, EVs, that kind of thing, that he says has actually brought down global inflation a bit. So, yes, I think China's been pretty defensive with its policies, despite the fact that we've seen a lot of this Western pushback over these claims of industrial overcapacity.
I think it really struck a nerve in Beijing, didn't it? Especially with Janet Yellen, now Olaf Scholz. Olaf Scholz needs to do a tight walk act, though, because he needs to sell German products still into China, and he has they're the biggest market for exports of German exports. But again, that inflation argument that China uses, but also he's saying, Xi Jinping is essentially saying, the other countries simply don't have the scale and the ability to produce at these lower costs.
Yes, exactly, Stephen. I mean, look, and yes, I'm glad that you brought up that bit about, Germany obviously needs to walk that sort of tightrope because of how important, China is Germany's main trading partner, so that really kind of underscores that message there. I did think that it was interesting that, it was specifically with Germany that China really delivered a lot of that pushback, because as we saw with Yellen's visit just the previous week, obviously that's not, it's not, President Joe Biden that came to visit, so Xi Jinping didn't meet with her. But we saw China kind of demur a little bit on dealing with the U.S. specifically. I'm not sure how much of that has to do with this big election that's coming up in November. We've obviously seen a lot of pushback, particularly from Donald Trump, who said that if he were elected, he would actually implement 60% tariffs on Chinese goods. So there's a lot of sort of political wrangling on all these different sides they have to deal with there.
You've been covering the IMF as well. What's been going on? There's been a change in the process here when it comes to debt restructurings, and a little bit of it has to be, I guess you could blame China on some of the delays that they've had in the past?
Yeah, I think so. A lot of the debate, so essentially what the IMF has done is they've sort of made some changes that shorten, or in effect would shorten the amount of time that you get from, a staff agreement to board sign off on some of these debt restructuring deals. I think that under these new changes that have to do with some of the ways in which these arrangements are ultimately reached, the IMF is saying we want these debt restructuring deals to take place over over 2 months rather than incredibly lengthy times. I think what you saw specifically with Sri Lanka last year, it took something like 9 months to actually to actually reach some of these deals. That maybe it was 6 months or so, but it was these really extended periods of time, and a lot of that was ultimately blamed with how China actually reaches these deals. Remember, I mean, China is the largest creditor for a lot of these emerging markets, and when it's essentially framing that against these more traditional structures outlined by these advanced economies, I think that timeline has been really difficult.
All right. Yeah.
The pushback China had was essentially that they are the one that has to take the haircut.
Yes,
right?
exactly.
Yeah, interesting. All right, Jill, thank you. Jill Deese is there, our news desk editor. And we're talking very closely when it comes to, of course, China, geopolitics and the like, with the New Zealand Prime Minister Christopher Luxon has reaffirmed his plans to visit China and cited the country's importance as an economic partner. He also expressed concern about rising tensions in the South China Sea, calling for de-escalation and a path towards stability and security.
New Zealand doesn't take a position on the individual claims within the South China Sea.
But you must be concerned because a lot of your trade passes through the South China Sea.
Correct. And what we do say is that we expect all parties to actually adhere to international law, and we certainly want the parties to de-escalate tensions and to negotiate diplomatically. That's very important to us. You are right. We are a small trading nation, and so things like freedom of navigation, international rule of law, those are values that are very important to us. We want to stand up for.
New Zealand has always adopted a conciliatory tone when it comes to China. How do you describe relations between the two countries right now?
Well, look, we have a long-standing and important relationship with China. It's been the case for many decades now. But what we do is we cooperate where we can, and that's in areas of trade and certainly in areas of climate change. We have a strong set of values, which where we have differences of opinion, given our differences in our political systems, where we stand up and actually predictably and consistently, publicly and privately, articulate where those differences are, and also where we see alignment with like-minded countries, we do that as well. But it's an important relationship for New Zealand. Yes, it's a complex one, but it's important that we actually continue to build and develop trade opportunities that are there, but equally stand up for where we have differences as well.
Some people have said that China's trying to get more influence in the Pacific. It's already signed a security deal with Solomon Islands and possibly Papua New Guinea. How do you look at China's presence in the Pacific? Are you concerned about it?
Well, look, I mean, it's certainly a more contested, Pacific than we've seen in recent decades. No doubt about that. Our view is very simply, it's a place that we call home, and we certainly partner very well with the other Pacific Island nations who are sovereign states in their own rights, as they work with different development partners. A bit like ASEAN centrality. We have something called the Pacific Island Forum, which is the central mechanism by which development partners should work with Pacific Island nations as well. So, for us, it's a region that is really suffering tremendously from climate change in particular, and so a lot of our focus in a development sense is working with our partners in the Pacific Islands to work with them on climate change, which for many of them is an existential threat.
How are you looking at building your relations with China? Are you planning to visit China anytime soon?
Look, I will do at some point.
This year?
Well, it won't be this year just by virtue of the schedule, but it is my intention to get to China, and it's a very important market for us.
How do you plan to build a relationship?
Well, I mean, we've already had a visit from the foreign minister. We've actually got my trade minister in China this week as well. So we have a long-standing relationship there. As I said, it's an area where a relationship where we cooperate around trade and climate change. And as you've seen, we are pretty consistent and predictable with the Chinese in private and also publicly, where we have differences.
That was the New Zealand Prime Minister Christopher Luxon there speaking with our colleague Heslina Ahmed. We got plenty more ahead. This is Bloomberg. All right, checking markets here right now. We are actually seeing some upside when it comes to your benchmarks in Greater China this morning. We're watching some of these Adidas suppliers here on the back of the firm really raising their profit outlook. So the likes of Shenzhou International is up some 2%. Prada, of course, we've been tracking all that goes on when it comes to luxury space, and LVMH did talk a little bit more about slower sales when it comes to Asia ex Japan, though China demand still seems to look pretty strong for that luxury maker. AIA with Morgan Stanley coming through when it comes to that call on the insurer saying that the fundamentals look a little bit better. And Galaxy Entertainment, that's the one where we're seeing some downgrades there from some brokerages talking about disappointing recovery overall. You take a look at how the FX side of things is. So the dollar, basically, we're snapping out of 5 days of gains, which is the best run we've seen in 14 months or so. But it's basically gained some 2% around that time, which is quite substantial. You take a look at how FX is doing here in this part of the world. So the Korean won, we stabilized a bit here after those rare comments from Korean officials about some verbal intervention about how they're ready to step in. We're strengthening some 0.7%. So we're back well off that 1400 level. Dollar yen still at 154, so you still have that intervention risk still quite there. And 726.11 for your dollar China. Of course, 730 could be the next test there. Mark Cranfield from our MLive blog saying maybe a second day of 710 for that PBOC fixing. Does that mean we're going to enter into a higher trading range for dollar China there? Equity benchmarks are in the green here with the CSI 300. Seems to be the one outperforming. We're up about a third of 1%. This is Bloomberg. Welcome back to the China Show, hour 2. Here's a look at the CSI 300 just a half hour into the session here. So we're doing a little bit better across greater China markets here today. In fact, you take a look at how onshore and offshore is doing. You're actually seeing a decent bid across the Shanghai Composite. Shenzhen's also back up. So a little bit of a rally here this morning on a wet day in Shanghai. And we're flat when it comes to MSCI China, though. But the rest of the region still seeing some modest declines, not as bad as yesterday, but certainly all these concerns about Jay Powell and talking about, the delays in rate cuts is once again sort of roiling that trade, but certainly looks a little bit more moderate than what we saw yesterday, which was quite ugly. U.S. Treasury yields are slightly back down, so we're at 4.97 after we briefly touched 5% for your U.S. 2-year yield, so there is some support at those levels now. U.S. 10-year yields also hovering around that 4.66%, and we're watching very closely what goes on when it comes to some of these tech-heavy benchmarks, as we talked about, that really got pummeled yesterday. Kospi and Nikkei still a down arrow story, but modest declines. But Taipei, there you go, seeing a decent rebound of 1%. It was interesting, some of the comments that we got from the BOE Governor Andrew Bailey overnight, talking about, look, the BOE could actually cut before the Fed does too, and that certainly led to that dollar strength to continue. And we're watching very closely these property developers as well. So it's a mixed bag, as you could tell. So yesterday there was a bit rally in some of these big names, like Siffy Holdings, for example. That's continuing up some 6% on reports from local media about some sort of national program to help acquire unfinished projects and the like. Sino-Ocean's up some 6%, but look at the top. Yuzhou Group and Times China, the clear outperformers there. Steve, you've been watching this Yuzhou Group a little bit here today as well. What's going on?
Yeah, it was up 40%, now down 10%. It's a penny stock. It's 8 Hong Kong cents. But again, 2 years ago, it was 59 cents, or it's down about 93%. We thought maybe it's on the white list. Maybe it's going to get some reprieve from this proposed, from Caixin at least, platform company that would buy up unfinished units and the like. Again, just speculation right now. This is a company that has been battered along with the other sectors.
Yep, so that's the property side of things. The small caps are also coming through here after 2 days of massive losses here. The CSRC also came through trying to re-clarify, I guess, some of these capital market reforms and really try to allay those concerns about delisting and all the like here. Asia FX is doing this here right now, so it's much calmer than yesterday, which is good. You're seeing some strength come back, but not quite there in terms of recovering some of the losses that we saw yesterday. But we're off the 1,400 level for Korean won. We did hear from Korean officials stepping in and saying that, at least verbally, saying that they will try to step in if needed. Taiwan dollar, we're still at around those 2016 lows. The ringgit is close to 26-year lows. The superlatives continue, and the rupiah just coming through on trade there. We're still continuing those declines and well above that 16,000 level, despite what we heard from BI actually did say they did intervene in that market. The rupee is the next one to watch. Slid to a record low yesterday. It's more about Jay Powell now, who's signaling rates will remain higher for longer than earlier expected. Take a listen from his speech in D.C.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's bring in Dominic Schnider now, head of global commodities and forex at UBS Global Wealth Management CIO.
Good morning.
It's great to have you back here in the region. I mean, it seems like we've been here before, Dominic, but then again, you talk about the comments that we heard from Jay Powell back in December, which was sort of the pivot. It seems like he's sort of reversing that right now. What do you make of those comments?
Yeah, absolutely. I think he definitely thought that inflation would come down a little bit faster. I think we all did. We just woke up and realized, okay, we need a little bit more time. And I think in that kind of process, what you're going to see is the dollar, which is well bid. And I think the risk here is obviously we see no cut at all. There's still a little bit more to price out on the future side.
And Asian central banks are left scrambling. What can they do? The dovish hike from Japan, from Governor Ueda, did nothing to prop up the yen at all. In fact, it's weakened towards 155. They're going to be meeting again at the end of this month. Is there anything he can do to stop this slide further? Other than the finance ministry.
Well, I mean, the BOJ definitely could. I mean, we have negative real rates. He could change that. I mean, it's in his power. Is he going to do that? No, probably not. And so I think then in that case, you shouldn't complain that your currency is under pressure. But I think it's fair to say that the latest movement in dollar yen has less to do really with the yen itself. You look at the crosses euro yen, which is pretty much flat since late March. So from that perspective, it's truly a dollar move. But there is no real support unless you show me a little bit more yield on the table.
So how long do you think, if you see central banks doubling down and stepping in to at least stabilize their currencies, how long do you think this FX intervention can last and should last? It all depends on the dollar moves, I'm guessing.
Yeah, I think what you can do is take out unwanted volatility. At the end of the day, I think it's very limited as long as the yield gap runs so much against you to really stabilize the currency at a fixed level, because the market would probably try to see if you really mean it. So I think the only thing is take out volatility. That can still mean that dollar yen, for example, trades at 155 and above at that levels in case rate cuts are fully priced out. But that's maybe a more short-term view. I mean, the market is already, specs accounts are heavily yen short already. And there's still one thing I like to highlight. Even though inflation was higher now, what we learned from the past is maybe not extrapolate certain things. So there could be a twist in inflation at some point in the second half of the year. And then we all look for cuts. And in that environment, I would say dollar yen should top.
So based on the data that you have, where are the dot plots shifting to? Well, towards the end of the year.
Yeah, but at least 2 cuts. I mean, that's the baseline. That needs to happen immediately. And then we see it from there. So I think we're looking for 2 cuts still at this point, because some of the elements in the CPI print were quite, like some of the insurance on cars, etc., they might not last very long. And so I think we still have confidence with wage growth slowing in the US that you get this inflation deceleration and the Fed is then ready to cut. And I think that helps us to bring an end to dollar strength as well.
I'm just wondering then, are you forecasting some sort of rebound then across Asian equities in the back half then? Once the Fed does start actually its rate cutting cycle, what has more room to actually rally substantially?
So I think as long as it's just a story about maybe we need to reprice or price out Fed rate cuts and we're not really seriously talking about hiking rates,
sure,
I think the equities in general can still do fine. We go maybe through a consolidation now, but overall we have seen actually the narrative building for a manufacturing recovery in the second half of the year. I think that element is still here after a quite dismal backdrop that we have seen in the developed world. So I think this manufacturing turnaround still holds ground to see equities a little bit higher.
And that should impact those currencies of those markets too, right? If you look at Korea, with the tech cycle seems to have bottomed in some ways too now. Absolutely.
I think this is one of the key things. I mean, you normally have 2 things shaping FX market: relative yields and the relative growth story. And it was so far U.S. exceptionalism all over again. But that could a little bit change in the second half of the year as we see maybe growth broadening out here. I mean, growth expectation for the U.S., by the way, are super high and they're super low for the rest of the world. So we don't need that much in order to get a little bit more positive. But obviously with higher rates, I mean, it pours a little bit cold water over the heated equity market.
Do you see a change in emphasis a little bit at the PBOC with the renminbi? They've tried to hold back the dollar strength. Now they've loosened the grip at least a little bit yesterday. But it's sending sort of mixed signals, isn't it?
Well, I think you're in a very tough spot. I mean, if you really don't want to move the currency that much, you're obviously bound to a lot of pressure. I still think maybe dollar CNY heads towards 7.35. You know, we might test some of the levels. As I mentioned, short term, we can still price out some of these Fed rate cuts. That we have there. So the pressure is there. You also look at the basic balance of payment. That's not great either. And if you ask myself, as an investor who holds a lot of CNY exposure, you're actually getting paid for hedge. So it's definitely a lot of pressure here that's likely to persist. Take away the currency risk. That would be my advice for an investor who is heavily CNY long at this point.
Okay, and what's more important in driving that yuan trade now? Is it more what the yen does or what the dollar does?
No, it's all about the dollar, I would say, at this point in time. And obviously, if you want to stick to the dollar, you need to allow for trade-weighted strength. The good story here is, if you look at the CNY in real trade-weighted terms, it actually went down a lot. So there is per se nothing wrong to let the currency a little bit strengthen in real trade-weighted terms. So I think that's why the PBOC will keep the CNY stable. But still, in this environment with the forward downward slope in dollar CNY, I would still hedge the currency risk.
All right, Dominic, he's staying with us. Dominic Schnider there from UBS. Still ahead, Rio Tinto's iron ore shipments slipped for the first quarter, and they're blaming China's uneven economic recovery. We have a closer look coming up next. This is Bloomberg. Watching the miners here this morning, of course, it's Rio Tinto, and talking about the iron ore shipments falling some 5%, which did miss the market expectations there. You're also seeing continued downside when it comes to BHP Group and Zijin Mining here today. For more, let's bring in our commodities reporter, Martin Ritchie. And Martin, just tell us a bit more about what we heard from Rio, in particular when it comes to what they're seeing on Chinese demand right now.
That's right. It was a bit of a miss on iron ore. Nothing too dramatic. I would look more at some of the Chinese commentary from Rio on the Chinese market, which is obviously their biggest buyer. Look, a very sort of sober assessment, I would say, of the market there. They point to some strength in manufacturing, but this ongoing weakness in the property market, which is obviously over the years has been a massive driver for iron ore demand. One thing that I thought was interesting was they flagged the rising Chinese steel exports, which has been a trend over the past few months, and we saw steel exports rise to the highest since 2016 last month. Now that means that Chinese steelmakers can sort of keep output running at higher levels than they otherwise would, and that feeds back to the iron ore miners. It helps demand for their product keep going, but it also feeds into this growing story around the world about Chinese industrial overcapacity.
Right.
Obviously, we're talking a lot about China's exports of things like solar panels, electric vehicles, batteries at the moment, but there's this undertow also of a surge in steel exports, which has always attracted complaints from around the world. So that was an interesting thing that Rio mentioned.
Martin, Steve Engel here. What does all this mean for iron ore prices? And also, when I came back from China a couple of weeks ago, there was a lot of talk about excess inventories of iron ore piling up at the ports. They have to work that off. So that will be a bit of a drag too, right?
Yeah, that's right. Obviously, it's not been a great year for iron ore prices. As you know, prices down by about a fifth this year. They did slump below $100 a ton last month. And look, the property sector is still a major drag. You've got some help from exports. You've got some help from other sectors in China. You've got a sort of price floor around 100, because that's where the marginal producers of iron ore start to feel pain, start to slow their shipments. But overall, there's probably not that much room for iron ore to really power higher again. We've seen the Chinese economy sort of pick up a little bit in the first quarter. I think analysts had flagged a lot of remaining headwinds, though, so that really feeds into Rio's assessment today, which was rather muted, I would say.
Okay, Martin, thank you. Martin Ritchie there, our commodities reporter joining us out of Shanghai. We just have a Bloomberg scoop that's just crossing the Bloomberg here right now when it comes to Morgan Stanley. So they are planning its biggest round of China job cuts in years. And what we're hearing, according to our sources, is that the bank plans to cut about 50 investment banking jobs in the APAC region this week, with at least 80% of those reductions are going to be here in Hong Kong as well as in China. That's according to people familiar with the matter. And that could affect about 13% of the 400 bankers in the region, excluding Japan. So that's the latest when it comes to Morgan Stanley. More news potentially when it comes to layoffs for the bank. We'll have more on that story a little bit later on. Let's bring back Dominic Schnider now, head of global commodities and FX at UBS Global Wealth Management, CIO. We were just talking about iron ore. Certainly that's one to watch. What do you make of terms of the Chinese demand picture for commodities this year now?
Well, I think in general you need to separate what happened on the property side, iron ore, which is clearly on the soft side. That's why prices on the bulks have come down quite a fair bit, and we maybe still need to find a floor. But there has been another side. I mean, manufacturing has been strong.
Yeah.
You can argue, okay, what we have seen in March, a little bit of a disappointment, but in general, Chinese, everything related to manufacturing has been robust. Look at copper, for example. I mean, without Chinese demand last year, we would have been a completely different place. So I think people need to separate and look a little bit into the detail below the surface. And I think the interesting part is here that commodity so far has held up pretty well. And versus equity, for example, the correlation has a little bit broken down. We're close to zero. And I think that gives it some allure because there's something else there, not just the broad macro picture.
Then there's the hedge and the safe haven aspect of gold and perhaps even silver. What's your outlook there?
No, absolutely. I think, look, on gold, we're positive, looking at $2,500 an ounce. Clearly, that's not really far where it is versus forward. But I think particularly silver has a little bit of a catch-up. We're looking at heading toward $32 an ounce. And I think the narrative is quite clear. While, you know, there's maybe still a little bit pricing out of rate cut on the Fed side, at one point that narrative can shift. And we still look at the manufacturing recovery, both come together. Silver can definitely rally a fair bit. So quite bullish on that one as well. And then the overall complex with oil, which we're basically getting paid to wait, which given the forward curve, makes the overall asset class quite attractive.
Can you tell us what's driving gold to touching 2,400 at one point? What do you think is the ultimate driver? If it's not the dollar, if it's not the Fed pricing, what is it that's really driving it the most?
No, I think there's been a combination of drivers. I think what we try to understand why it didn't happen with a little bit of inflation expectation coming up. So you look at break-evens changing over the last 6 months, and you look at how gold moved, that explains it quite nicely. Maybe not the magnitude, but it gives you a little bit of a hint why people were looking at gold. But the underlying issue is deficits. Then we do have the challenge in China. So China's demand is strong, central bank buying, and then geopolitics. So you load up all the four. Why would you not have something like gold in your portfolio? So I think it's a combination of factors. What does it need to rally from here? And I think that's the most important thing. We need ETF buyings. Haven't seen that yet, but that should come at some point when the Fed obviously starts to cut. I think then we have that additional oomph to do the next leg higher.
You talked about copper just a few minutes ago and some of the other industrial metals, whether it's nickel and zinc and the like. We've been trying to ask the same question about how does one invest in new productive forces, the big shift that Xi Jinping has been pushing in China towards high-end manufacturing. Where can an investor leverage on those particular industrial metals if it's going into more EVs, into batteries, solar, and the like?
Well, I do think copper is clearly the standout here because it has a supply challenge at this point in time. We're barely going to grow mine supply. And without copper, no energy transition. I think that needs to be clear. But we also need to be a little bit more nuanced. For example, nickel, even though it went up lately, there's so much supply, almost 10% supply growth. So as an investor, have a little bit of a nuanced approach. But copper would be my go-to metal to think about, 10,500, our target.
Oil, certainly there's been a lot of Middle East tensions and the like. There seems to be still a sort of a growing sense of calm right now at $90 for Brent. Can we hold around these levels for some time, or should we be worried about disruption of potential supplies too?
No, I think we should be here. I think that's a good level. I mean, the point is oil needs to really rally a credible threat to supply. And if you listen to everybody in the market, nobody wants any disruption. I mean, if you're running for presidency, clearly you don't want to have any disruption at this point in time, or somewhere in the East, neither. So I think that keeps oil well bid. But I think the interesting part is that, disruption of 1 million, 2 million barrels, the market could clearly not handle without a higher price. We do have spare capacity. Keep in mind, OPEC Plus has 5 to 6 million spare capacity, so there's no need to a runaway rally, but that's probably good enough in a crisis to push oil towards 100. And now comes the most important part. It pays to wait. And I think that's the most, if you think about an insurance asset that you buy, normally you need to pay and nothing gets back. Here in that case, you can buy oil at a discount, and oil in real terms is actually cheap. So I think,
So that is the next big worry on the oil markets, is any escalation in the Middle East with Iran.
No, absolutely. I think this is, if we see some actual supply being curtailed, OPEC Plus somewhere else needs to push up the output, and that would simply come at a higher price.
All right, Dominic, great to have you back here. Dominic Schnider, their head of global commodities and Forex at UBS Global Wealth Management CIO. Just want to check when it comes to your MXAP intraday here this morning, and you are still seeing some modest declines, and we're still on track to erase basically all the gains that we made this year, just given, of course, what we've been hearing so far from Jay Powell, the like here. So overall, the declines have been a bit more marginal. We're down about 0.7% on the topics here. Hang Seng is also down, but onshore stocks at least are still doing much better here today as well. Taiwan also a clear outperformer. We're up some 1% in Taipei. We got plenty more ahead. This is Bloomberg. The IMF has inched up its expectations for global economic growth this year. It now sees output expanding 3.2% worldwide. And the fund's latest World Economic Outlook report cites strength in the U.S. and some emerging markets, while warning that the outlook remains cautious amid persistent inflation and geopolitical risks. And it's urging China to find ways to offset headwinds from its property crisis.
With an economy that has potentially still relatively weak domestic demand, but is growing, then there will be an increased reliance on the export sector, and that is something that, in the context of very tight trade tensions, could be complicated. And so certainly there would be, in the interest of the Chinese economy to develop ways of sustaining domestic demand.
Meanwhile, the U.S. will impose new sanctions targeting Iran's missile and drone program, according to a White House statement. Entities supporting the Iranian military and defense ministry will also be targeted. The move comes after Iran attacked Israel over the weekend in retaliation for an Israeli strike on its diplomatic compound in Syria. And Dubai has seen torrential rains and heavy flooding, prompting flight cancellations, school closures, and traffic disruptions. It stemmed partly from cloud seeding operations that are meant to encourage rainfall in the UAE. More than 40 flights were canceled and operations were suspended for 25 minutes at the Dubai International Airport, one of the busiest hubs in the world. We're taking a look when it comes to your markets here this morning. So we're still seeing some declines across equity benchmarks here in the region. We're focusing on some of the banks as well as the casinos as well. JP Morgan coming out with an interesting note talking about the disappointment when it comes to recovery as well. JP Morgan also downgrading the likes of Galaxy and Melco too. We're down some 6% for Galaxy this morning. And we're watching these Chinese banks too, with Fitch talking a little bit more about downgrading the outlook when it comes to some of these state banks as well. Not a whole lot of movement, though. You're seeing Bank of China down close to 1%. And we're watching some of these brokerages also. UBS Securities down some 4.5%. Coming up next, we're going to talk about Bitcoin with Token Bay Capital as the crypto sector gears up for a halving event. That's later on this week as well. This is Bloomberg. All right. 11:29 a.m. in Tokyo. Of course, we're heading to that lunch break and seeing some marginal declines Here, the topics is down 0.6%, 154 territory, though, for dollar yen. So certainly still watching whether we do see any signs of verbal intervention or the like from Japanese officials here this morning. You take a look when it comes to what we're checking across the market. I mean, it basically is a sense of stabilization, I guess you could say, from yesterday, right? So we're flat now when it comes to the Asia-Pacific gauge. So we'll see if we could actually start to see some gains. We might still hold on to some gains for 2024. U.S. futures are also punching a bit higher, so maybe we could be seeing a decent day in Wall Street today. U.S. dollar also snapping out of 5 days of losses. So things are looking a little bit more tame. You take a look at how sector by sector, it's a mixed picture, but tech seems to be the one that's recovering the most here today as well. In terms of what treasuries are doing, obviously the Jay Powell comments did send that 2-year yield briefly touching that 5%. We come off that just a bit here. We're actually seeing a decent bid, about 1 basis point down here when it comes to that U.S. 2-year yield. We're just at around 4.97 here right now, and 4.65 for your U.S. 10-year yield. So there is still a bit of a rally, actually, you could say, when it comes to treasuries, or at least a little bit of a reversal from what we've seen in the last few days or so as well. The PGIM CEO, David Hunt, is seeing that bonds making a comeback in the next few years, and he told us more about the factors behind a migration from money market funds to other assets.
You know, certainly at a higher level of interest rates relative to money market funds. And as we begin to see rates peak and then decline, duration begins to look a little bit more attractive. But there are two other things that are going on which are at least as important. One is that the big pension funds with higher rates are actually better funded. And so they actually are using this as a chance to de-risk, and that means for them they are moving money into fixed income. And the second is that we have the continued demographic trends going on, not just in this country but around the world. And retirees need income. So we are in the process now of this huge shift from accumulation products to decumulation and income products. And those need fixed income. So if you take the kind of short-term shift, you add to them two structural shifts, we think over the next 3 years, we really are seeing to see bonds are back.
This sounds like a new regime, and I'm going to give your team a bit of a shout-out because you're a modest man. Mike Collins, Greg Peters, Robert Tipp, just absolutely phenomenal. Pre-pandemic, really defining that bond market regime of yesteryear. Can you talk to me about how different this regime is going to be compared to that one?
We think it will be different, and you're right. They were right on the lower for longer for quite a long time in that, and then more recently, our call has actually been that we're going to be higher. So if you go back 6 months, we were very early to the, hey, we're looking at kind of 2 cuts for 24 when the market was pricing in 7. And we held with that view, and the market's kind of come back to us at this point. So we pride ourselves on taking, I think, considered non-consensus views that are long-term in nature rather than simply trading views.
That was the PGIM CEO, David Hunt, speaking with John Farrow there. Of course, we've been talking about what's been going on in the banking sector, obviously with that Morgan Stanley scoop as well. Steve, there's been a lot of talk about brokerages in China as well. Today, they've been talking about violations, and that's why we're seeing a lot of these brokerages fall. But there's a harsh new reality, and really we're seeing a pullback in some of these research jobs.
Yeah, there were a lot of equity research jobs that are created during the up times, but we've had a real bear market, obviously. One Shenzhen-based brokerage laying off 40% of its analysts in the first quarter, slashed bonuses by more than 50%. So there is a definite pullback as profitability at the brokerages have been slumping as well, along with the market performance. And keep in mind, these analysts, most of them cannot do sell ratings, right?
Yeah.
Their research is heavily scrutinized by the government. So in a down market, they're even under more pressure.
All right. Let's talk a bit more about this, not just when it comes to job cuts in the brokerages, but also what we've been hearing in the last couple of minutes of Bloomberg learning that Morgan Stanley is planning to start cutting about 50 investment banking jobs in the Asia-Pacific region this week, with at least 80% of the reductions coming through here in Hong Kong as well as in China. Let's get the details now from our Bloomberg finance editor, Adam Haig. And Adam, just tell us a bit more about what we know about these layoffs so far.
Well, so far, Yvonne, we do know that it will affect about 50 roles across investment banking at Morgan Stanley. But as you alluded to, that is a big chunk, around 80% of the presence that Morgan Stanley has in both Hong Kong and mainland China. And these are pretty much the deepest cuts we've seen at Morgan Stanley for some time, for some years. And if you think about the context around not just Morgan Stanley, but some of their key competitors, notably HSBC, but also, of course, UBS and Bank of America that are also cutting roles in this region of the world, it speaks to the continued troubles that banks are facing as they adjust to the new economic reality and forecasts ahead of a very fragile economic outlook. So a lot of these banks had positioned going into this year to have largely done what they needed to for 2024. But clearly we're seeing that some moves around the edges still need to take place, and the investment banking landscape, of course, continues to be quite troubled, and this speaks particularly to the troubles that we're seeing in China, the ongoing subdued activity in the M&A deal space in mainland China, and Morgan Stanley feeling the need that they need to still make some changes to their headcount in this part of the world.
Yeah, Adam, Stephen Engel here. Definitely been a dearth of IPOs here in Hong Kong for sure in deal making. On other big U.S. lenders, trading businesses, including equities and fixed income, are back in focus. Why are these units topping forecasts?
Well, in many ways, of course, Steve, these are kind of manifestations of what has been happening in markets. You've had this big boom in many equity markets, of course, Japan notably in this part of the world, but activity in equities has clearly picked up, and you're seeing that in some of these results from the likes of Bank of America recently. But, of course, not just equities. The fixed income markets have seen kind of a renewed sense of volatility with the repricing of interest rate expectations, not just in the US, but really across most of the developed world in recent months. If you cast your mind, just back 3-4 months ago, the scenario was very different to what markets are pricing today. So all that renewed volatility and activity that you've seen in fixed income markets is being reflected in these improved numbers at some of these banks. And what that's doing really is offsetting some of the subdued activity that we're seeing in lending, that continued pressure in net interest income, and you're seeing this activity on the one side being one key bright spot that's coming out of the Wall Street bank earnings of the last few days.
And Adam, how are these bank bosses feeling about this sort of broader move, this repricing of the Fed, and that maybe we might not see those steep rate cuts this year?
Well, of course, Yvonne, that lots of people have had to change their mind quite quickly and repeatedly over the last few months. You could have gone from 5 cuts to just 3 cuts to maybe even just 2 or 1 from the Fed to plenty of people thinking that maybe the Fed doesn't even move at all over the next 6 months. So I think the CEOs of these banks are cognizant of the fact that the economy is kind of giving them data to feel like the environment is a little bit more benign than it was 6 months ago, which allows them a little bit more flexibility. But as I was alluding to before, a lot of this repositioning for the economic outlook had already happened, and last year a lot of these restructuring at banks, including the big one, of course, at Citigroup globally, they've been restructuring, they've been tweaking headcount, they've been making the changes so that they're in the right place for whatever the economy does. So I think, in a way, a more benign US economic outlook in some way suits these banks, and you are seeing that reflected in valuations.
Adam, thank you. Adam Haig there, our Bloomberg finance editor, joining us with the latest. We're also going to have an exclusive interview with the JP Morgan Chase CEO, Jamie Dimon, in the second season premiere of The Circuit with Emily Chang. You can see it here on Bloomberg Television at 6 p.m. Wednesday, New York time. That's going to be 6 a.m. Thursday if you're watching in Hong Kong. We got plenty more ahead. This is Bloomberg. Well, the Bitcoin bulls are saying that the crypto token could actually hit the $70,000 level before the so-called halving event set for April 19th. Our Annabelle Jewelers takes a look at what Bitcoin halving really means and how it may affect prices.
The Olympics, Sporting World Cups, leap years, and Bitcoin halving. They each happen every 4 years, and in the crypto world, halving's typically meant a boon for prices. In a nutshell, Bitcoin halving means fewer new tokens are issued. That's because Bitcoin miners who validate blockchain transactions receive 50% less of a reward for doing so. At Bitcoin's launch in 2009, miners received 50 new coins per block. Post the halving in 2024, that'll be cut to just 3.125 Bitcoin instead. In the past, we've seen prices spike following the event. For example, in 2012, when the token jumped by 8,000% in the following 12 months. This time around, the prospect for further gains is unclear. Some analysts say the halving could trigger upside of at least 80%. Others argue the event is already baked in, particularly as Bitcoin's already risen to fresh records this year, which brings to mind a familiar phrase: past performance does not guarantee future results.
Our Animal Jewelers there with a bit of explainer what this all means. Let's bring in Lucy Gazmararian now, founder and managing partner at digital assets focused venture fund Token Bay Capital. She joins us from Abu Dhabi early this morning. Lucy, it's always great to have you. Obviously we've been talking about what this Bitcoin halving means. How do you think this cycle differs from previous ones that we've seen in the past?
There are a couple of combinations. There are a couple of big factors, actually. There's really sort of setting this halving apart from the rest. Aside from just the whole industry itself maturing, every 4 years we see incredible building and innovation that continues to sort of accelerate, regardless of whether media attention is on the price of the coins themselves. The building continues unabated. But the real sort of differentiator, I would say, in this halving is the entry or the access for institutional investors to come in a meaningful way. And the way that they're able to do that is through the new spot Bitcoin ETFs that we saw launched in the US in January. Now there's an easy, compliant way to get exposure to the asset class. They don't need to be concerned about the operational risks of how to custody these Bitcoin. And so it can become a long-term play for institutional asset managers, but it can also become a trading tool for prop traders, for hedge funds, and really it's just deepening interest in the market and maturing effectively the whole Bitcoin ecosystem. So, and also, of course, the ETFs are going to enable retail to have easy access. Mm-hmm. So this new entry point for these key players, I think, is quite an incredible moment. And we've seen the demand in just the first few months of launch. We're into the billions now of flows. And in the words of Larry Fink himself, it's the fastest growing ETF in history.
And so do you think this halving, I mean, is that's what's been driving the Bitcoin price, or is it more the ETF story? I'm just wondering, does this halving have, prompt more gains to really lift Bitcoin a bit higher, or do you think a lot of this has been priced in already?
So the halving is an anticipated event. It's programmed into the software. We know that from day one. It's a feature of Bitcoin and the way that the network works, the way that it controls inflation. And so it's priced in to the extent that we've seen the patterns. But what's different on the pricing front with this halving is actually we've seen Bitcoin reach all-time highs before the halving. And that's somewhat unusual. Bearing in mind, we've only had 3 halvings and we've got 64 more halvings to go. So, as we go along, we're going to be able to see more patterns. We're still very early innings here in terms of sort of looking too much in the past price movement action. But also, we've seen it reach all-time highs. But again, Bitcoin softening price-wise as we're coming into the halving. So, nothing too out of step with what we've seen in previous cycles.
And so I'm just wondering, what does this mean for the miners? I mean, obviously, as you mentioned, this has been well telegraphed. Many are well prepared for this event, but this could lead to quite a bit of consolidation. I mean, is this just something where the larger players are going to survive? How do you think that's going to play out?
So the mining business is actually very competitive because consensus for the price of Bitcoin is now very optimistic. I mean, we've got price targets out there for one Bitcoin to be worth 1.5 million by 2030. So it's a competitive industry. And miners are now publicly listed companies in the US. And so they're being run in a much more professional manner. And while revenues will be cut in half following the halving, because the rewards that they earn for mining these blocks of transactions will cut in half, They have been working to ensure their balance sheets are robust ahead of this halving, selling Bitcoin, taking profits where necessary, indeed consolidating with other miners, looking at other ways to cut costs and ensure that they're investing in equipment that gives them the highest chance of winning these rewards. You know, they need the latest equipment.
Yeah.
So there are a number of different ways that they can position themselves for this. But yes, history has shown that your revenues cut in half with the halving in the month after the halving. But then if you look over the following months and years, the miners' revenues start to go into the hundreds of percent. It's a highly profitable business for the miners that are well run.
I want to get to the other news that we've been tracking here in Hong Kong, which is basically regulators here giving that initial nod to spot Bitcoin and Ether ETFs. How big of a deal is this, Lucy? And what are you projecting in terms of AUM inflows now?
So I think this is a very big deal for Asia specifically. There are a few factors that make this particularly interesting development. One, the fact that it's Hong Kong. And if you look at mainland China, crypto, including Bitcoin and Ethereum, because we had not only a spot Bitcoin ETF approved, we had a spot Ethereum ETF approved. These cryptocurrencies are actually banned on the mainland. So the fact that the first mover in Asia for a spot ETF, crypto ETF, both Bitcoin and Ether is Hong Kong, is interesting in and of itself. So then you start to sort of think how and why. And there are a few different takes out there in the market. Hong Kong has definitely been looking to remodel itself as a digital asset hub, a Web3 hub, driving forwards in the innovation. China supports blockchain development. They believe that this is the future of the internet, you know, an internet of value. So it's quite hard to completely block any access to the two most significant coins in the blockchain industry, which is Bitcoin and Ethereum. And with the growing institutional interest that we're seeing in the US, we're opening up that opportunity now to asset managers in Asia and even the mainland asset managers who are opening Hong Kong subsidiaries and looking to potentially gain exposure. Now, the extent of demand from this sort of institutional money that is making its way over to Hong Kong for these ETFs remains to be seen. But, you know, to the extent that these ETFs are accessible to retail and institutional in China is going to be really interesting to see what the demand is.
Yeah, that's interesting, right? These southbound flows to Hong Kong. Lucy, and then, you know, as crypto becomes more mainstream, then are people looking at Bitcoin and digital gold as the new gold? Are we likely to see some sort of rotation from gold to cryptocurrencies now as a portfolio diversifier? What sort of questions do you get around that sometime?
I think it's actually interesting. If you look at the flows from Q1, there is somewhat of a rotation going out of the gold ETF into the new Bitcoin ETF. So it's certainly capturing some of that from a transition perspective. Are investors looking to diversify into the world's new digital gold versus traditional physical gold? I think in the new generations of investors, they actually view Bitcoin as a more interesting play, as a sort of a way to store value, a store of value, because you can do a lot more with Bitcoin than you can with physical gold. If you look at the decentralized finance applications on blockchains, including the Bitcoin blockchain, you can actually stake your Bitcoin and borrow against it. These are very standard procedures. So it's a much more user-friendly asset. You can derive a lot more value from it. At the moment, there's very little you can do with your gold ETF other than just hold it in your portfolio. But Bitcoin gives you a lot more flexibility in the world of crypto and blockchain and all the decentralized financial applications we have out there. So I think we're seeing signs that it's definitely vying for that position in overall asset management allocation. But let's see if it continues to grow and really capture, you know, that 16 trillion market that gold currently sits at.
Yeah, it's interesting. We haven't seen that much demand on those gold ETFs, as our previous guest mentioned, despite record highs for the price of gold as well. Lucy, it's great to have you. Lucy Gazmararian, their founder and managing partner at digital assets focused venture fund Token Bay Capital. Just checking when it comes to crypto and how things are doing here. I continue to see this rally when it comes to Bitcoin here this morning. We're just hovering on that 63,781 level. Ethereum is catching a slight bid, but Solana is not doing too well here in the face of all that. We got putting more ahead. This is Bloomberg. Turning to today's China Brief now, look at some of the stories making headlines in national news outlets as well as trending online. Now, an opinion piece in the Economic Daily calls for special policy measures against those who smear and slander private entrepreneurs. It says that websites should also do their part to ban so-called rumor mongers. Now, last month we did hear from, of course, the Chinese beverage giant Nongfu Spring was targeted by online trolls, and that resulted actually in a drag on its stock as well. Over at the Global Times, some commentary on China's latest economic figures as well. Analysts are saying that the data has debunked the so-called peak China theory, saying that, quote, U.S.-led ideological prejudice against Beijing will not shake the country's economic development. Elsewhere, Xinhua's front page was also focused on German Chancellor Olaf Scholz's meeting with President Xi. Now, the article does emphasize the ties between the two countries and says that global challenges cannot be solved without countries working together. Now, China's ties with Germany and Scholz's visit also being pushed on social media as well, with promoted posts on Weibo talking about this. There's not a whole lot of, much discussion. But what we've seen is that the comment section has been highly censored, Steve, which, of course, it is a pretty sensitive subject when it comes to geopolitics.
Yeah, it's a tightrope. Obviously, Olaf Scholz has had to walk. He wants to continue trade with his biggest trading partner, China. But at the same time, it's against the backdrop of EC President Ursula von der Leyen, who has been pushing a lot of possible subsidies coming down the pike and trade restrictions because of distorted trade from her perspective. So it makes sense for state media to kind of court Olaf Scholz's opinion.
Yeah, and we certainly heard from the president in his remarks and really just saying, this has actually helped, Chinese exports actually helped tame inflation around the world in some ways as well. So at least, putting a positive spin on all that as well. You take a look at how markets are doing overall. And my thanks to Steve for playing my buddy for the last 2 hours or so. You take a look at when it comes, it's much more calm. So you take a look at how we're seeing, the peso is still weakening. So we're well above that 57 level now, which is where we've seen intervention in the past. So something to watch out for. In fact, intervention in most of these currencies is something that we're still on watch for as well. We're still seeing that recovery when it comes to the Korean won, so it's strengthening the most here, and we're well off that 1400 level. But there was talks of Korea and Japan talking about the volatility in these markets as well. That's it for us here on the China Show.